Guys, can you hear me? Can you see me? Please type a quick yes if everything is okay. Thank you so much, Vincenzo. Perfect. Thank you, guys. So for those who see me for first time, my name is Theo. I'm here purely to introduce you to your host for today. And you can continue with the non-farm payroll. I'm sure everyone saw the outcome on the non-farm payroll, and we're waiting for Jens to join us and discuss a bit more. So before we start, please make sure you subscribe on the YouTube channel. You can find all the useful links here for the from the live trading to the trading spotlight, where Paul, Jens, myself, we put the webinars there, the recordings, and also the Instagram page on a daily basis, content here that will help you. And just quickly allow me to share the Telegram. Now you already see, I'm sure at least most of you, that you can comment on the Telegram post, and I encourage you to use it, guys, because it's a great tool. First, you can communicate with me. Isn't that great? I'm joking. Come on. So yes, exciting news. Some trend reversals. We expect them to see on the from Monday onwards, and we're going to talk about this extensively on the live trading webinars on Monday, on Tuesday, and every day. So it's time. The trading community is waiting for Mr. Jens to join us and tell us why these non-farm payrolls all the time, but always they diverge so much from the the outcome. It's so much different from the forecast.
What are you talking about, Theo? What are you talking about?
What's going on in the markets?
Really? Just like, what shall I say? I was like, okay, I really had to take a deep breath now and then refocus and once again think about what I want to present to the audience here, because the problem is this is so ridiculous that you really can't explain this. I just looked up. There was a tweet appearing in my timeline saying that this was an 8 Sigma event, and it was like, okay, what is 8 Sigma? So just to compare this to somewhere, and then I found an article saying it's not clearly whether it's 8 Sigma, but 10 Sigma. This is as likely as that you spot a purple dotted swan somewhere right now. So
yeah, so true. It's like, come on, it's been since Wednesday, the Fed, they increased the interest rate only by 25 basic points, and Bank of England increased yesterday, the Eurozone increased yesterday, and all over the sudden we had all this bearish engulfing on the majors. And today, surprisingly, the non-farm payroll, they came to smash everything. So okay, the US economy is doing so well.
ADP, right? So ADP data came in something like 100,000 or so for the private sector on Wednesday. It's like, okay, now, well, probably market is anticipating something, because you say, okay, that wasn't really hawkish. The rhetoric being used, especially from Powell, and markets rallying, and you just think, okay, well, probably anticipation of weak non-farm payroll, something like that. Well, what should we say? I mean, let's just trade the price action, observe what the market does, and then take it from there.
Exactly. I'm sure this webinar session, they're going to be very exciting for the audience. And I see that Vincenzo had a good earning today. Well done, Vincenzo. That's great. I'm sure
Vincenzo still earning,
something.
Still earning. So keep on going short the NASDAQ. And why that? In a few minutes, you will find out why.
All right. So
shall I share my screen?
Just give me one sec. Yes. Yes.
So,
Okay,
yeah,
perfect.
well,
So enjoy the session.
yeah, hope the best.
Yeah.
So yes, hello, and I welcome you from German, Berlin, Berlin, Germany. I'm sorry, the other way around. So with the non-farm payrolls, the release we just witnessed, and again, as I already said, it's an 8 Sigma event. That was something I saw in my timeline appearing. Was from Zero Hedge, 517,000. Jobs added, taking out the agricultural sector. Wherever this number comes from, well, probably they have a new way to calculate the numbers at the BLS. I don't know. Probably it's another definition of how the numbers come in. You remember probably the White House around Joe Biden, the Biden administration, just found a new definition for recession. I mean, well, certainly it's difficult to really see a recession here with this job report, especially. But there's usually the saying that if you see 2 quarters in a row of negative GDP growth, that then, technically speaking, the underlying economy finds itself in a recession. So there's an inversion of a 2- and 10-year yield curve. We all discussed this here within our fundamental analysis overview over the last month. So and then they came out saying, well, no, we're not in a recession because of this and that definition, whatever. So probably they do the same now with calculating the job numbers. I think the unemployment rate came in at the lowest level since 1969, if I'm not mistaken. So really crushing job numbers. No one really knows where this is coming from, especially, I mean, look at what the big tech companies are doing. We'll have a look at certainly also when looking at the NASDAQ here. Today, we have to have a look at Apple. We have to have a look at Amazon. We have to have a look at Google, for example. We can also have a look at Meta, for example, Facebook in this case. So laying off thousands, 10,000s of people over the course of the last months, in fact. And so this is also spilling over to other sectors, or respectively smaller companies, mid-sized to smaller companies, certainly. So very difficult to see why this job report just crushed it as it did. But however it is, at the end of the day, we are traders, right? And so we have to take everything we are presented there, and then just take it from there. So before we start, please read carefully through the risk disclaimer and be aware that trading involves risk, especially when trading leverage products. So it could be that today we will formulate a trading setup, especially given the price action we currently witness, given what we've seen yesterday with the earnings releases, and the NASDAQ having gone nearly, it's not parabolic, but really steep on the upside. By the way, how to define steepness in this case from a technical perspective, I will go through this here with my method to measure whether we are a little extended, let's say, on the upside. And now we are breaking below the lows. So there was a drift higher in the pre-market. So, okay, long thing short, it could be that we are formulating a trade setup based on the price action we witnessed. Please be aware that everything I present to you here is for educational purposes only. So if you plan to trade based on my thoughts or take a trade based on the setup, we will formulate whatever. Please be aware that and be sure that you understand the risks involved, and that if you lose money, that you're fully responsible for any losses you might see here. But on the other hand, if the thesis plays out, we will certainly also keep all profits. So that's a positive sign of this. But first of all, please be aware of the risks involved when trading. Everything I present to you here is for educational purposes only. I don't need to introduce Admirals any further. I think Theo already did an awesome job there. Before we head over in this context now to the charts and have a look at the numbers. First of all, I want to make sure that we are all on the same page when it comes to the fundamental idea behind the employment situation and why this matters. So you can build some kind of a chain here, starting with confidence in economies respectively, and in politics in this case. If this is good, which is certainly not the case. It doesn't matter whether you're in Europe, whether you're in the US. I think the division of the country is clearly visible. But usually what you say, if the overall confidence is good, you see an increase in orders in factories. We only go for the manufacturing sector here. I think this is easier to understand. We are not focusing on non-manufacturing sector. By the way, today we also get numbers here from the ISM non-manufacturing a little later, something like in an hour or so. We focus here because you can clearly paint this and picture that. So we are not focusing here on something like the service sector, respectively, online stuff or so, but we're focusing here on a manufacturing sector and factories in this case. I think this is easier than to grasp the concept, even though it certainly is also true for the non-manufacturing side. So if there's an increased confidence in the overall politicians and their behavior, and you really look into a prosperous future, you usually see that factories increase their orders because they look into a stable future in this context, and they want to produce more to fulfill the demand from people who want to buy more stuff, like cars, let's say, or computers, whatever. And what you then naturally see is, as a result, you see an increase in industrial production. This is also a number worth watching, even though it's not as, let's say, volatile or creating as much volatility as right now. Numbers around the employment situation, respectively, inflation is creating inflation, volatility. And so industrial production, that means that companies will meet higher demand through more investments. And what does more investments mean? It just doesn't mean they will hire more people. So you see a drop in unemployment, or respectively more people employed to work for companies to fulfill the needs of the consumer at the end, to produce more goods. And that means, well, naturally, usually you have workers who want to have money, right? So you want to earn money by working for a company, and thus the company has to pay you an attractive salary. If you're not compensated accordingly, well, you join another company. If this happens too often, well, then you can't profit from this overall, let's call it, optimistic environment as a company. So you have to pay attractive salaries in this case. So that means also that you get to see an increase in average hourly wages, which means people have more money in their pocket. It's not just that they produce more goods, but also they have more money and they want to spend it. Go on vacation, buy stuff, whatever it might be, which means if they have more money, and this increases naturally the consumption, which means there is a higher propensity to consume. And the result naturally is that you have higher economic growth plus rising inflation, because there's no more money chasing goods, and there's a natural acceleration in money flowing around, which means that there's also pickup in inflation, which will then result in central banks being motivated to raise rates to counter any or to avoid an overheating of the economy here in this case, and inflation getting out of control, and vice versa. Now, this is the basic theory behind this. And as you can see here, so hiring more workers to fulfill more needs is obviously what is driving inflation. Right now, the overall situation is different. We have inflation, which got out of control. It's not just in the US, but also in Europe, in the UK. And this is mainly due to the excess in terms of liquidity, which was pumped into the system from central banks, which resulted here in higher prices, asset price bubbles, which got out of control. And so that being said, well, then resulted in, and especially it wasn't just asset price bubbles, which we got to see, but it was the pop of the or the great financial crisis, which triggered here this massive inflow of cheap liquidity into the markets from central banks around the globe. And so then we had COVID, we had the pandemic, we had shutdowns or lockdowns at least, and then there was no further goods being produced. Supply chains were interrupted. You could see this also in China, for example, and that, well, what happened was that people stayed at home while the governments around the globe countered here any pressure which was building behind the walls, let's say, and people getting frustrated and asking, well, why do we have to stay at home? I mean, certainly you can sell it to a certain point and tell them, well, there's a pandemic and people are dying. But the longer people started to think about this and the more frustrated people got, the more there was the need to somehow keep them calm, let's say. And so how they countered that was they pumped liquidity into the system. So they were saving the economy, central banks, or saving companies especially, pumping liquidity, cheap liquidity into the system, handing out stimulus checks to people and telling them, hey guys, well, stay at home, here's money. Well, spend it on, let's say, e-commerce giants like Amazon or something like that. And well, then we lift the lockdown and there was fewer goods. So you need the engine start running again. And now you have fewer goods because of the interruptions of the supply chains. And there was lots of liquidity chasing these goods, which pushed inflation higher. But it wasn't that we had here now any signs of let's say, an overheating of the economy or something like that, because the economy stood still. So it wasn't a demand-driven inflation we're currently facing also, but it was supply-driven, or it is supply-driven, because there is not enough supply, and all the money which chases the goods and this is flowing around faster and faster is driving inflation higher. To counter that now, because it also started to affect negatively overall economy. So what did we get to see? Well, you have businesses who are facing higher and higher costs when it comes to produce goods, which they then forward to the consumer. But this usually reduces the demand of the goods, because if you increase the prices and people are not capable of paying any further, well, you naturally will step back. This is especially true also from an advertisement perspective. If we look at the non-manufacturing sector, for example, Google and so on and so forth. So you see a reduction when it comes to ads. If you have less income or less revenue and less income, well, that will naturally result that people, some companies will react in a very simple way. They will fire people. They will lay them off because now they don't need them anymore. Respectively, they can't afford them anymore. So you're laying these people off. This is what we got to see. And now we see this massive outlier, let's call it. The great thing is that I prepared this presentation shortly before I started, shortly before the non-farm payrolls were released. So what we have here is the Fed Watch tool. So now we want to see, especially when looking at the unemployment situation, respectively at the non-farm payrolls itself, what will the Fed likely do? Respectively, what is the market expecting? And therefore, we use here the Fed Watch tool. And by the way, let me just here share the link, copy link, and then here I share it in the chat. So you can check this out yourself and play around a little. So what I did is I clicked here till the end of the year, December 2023. And I want to see what the market is expecting the Fed to do till the end of the year. So right now, it was on Wednesday, we saw a hike of 25 basis points. We expect another 25 basis point rate hike in March, which will bring us then to a target rate. Here you can see that current target rate is 450 to 475. Let me just check here the chart. Okay, 450 to 475. Another 25 basis points brings us to 475 to 500. And then you will see that there's a peak out and that there's a rollover. And at the end of the year, you see that was before the non-farm payrolls were released, by the way, that we're in December expecting the target rate to be at 425 to 450. That means the market is already expecting the Fed to cut rates because the overall monetary policy path we're following right now is considered to be too restrictive for the overall economy. So that means the market is expecting the economy to cool down further. It already did over the course of the last quarters. It became obvious when looking at the GDP data, for example. from the US especially, and you expect the Fed to cut rates in the second half of the year. Interesting thing is, if you carefully listened to what Fed Chairman Powell delivered on Wednesday, respectively, if you, in addition to that, you remember what we've seen in the economic projections at the end of December 2022, so around 2 months ago, you could see that the Fed officials saw the target rate at 500 to 525 basis points. This is a so-called dot plot. I haven't prepared it here, but this is where Fed officials see the target rate at the end of the year, 2023. And in addition to that, there was also a clear saying from Powell that there is further hikes to be expected. So when looking at the market and the recent rally on the upside, it's quite obvious that the market is not believing what Powell is saying. Now, this is countered by a quite strong jobs report and the non-farm payrolls, which were just released. So this is just to give an overall idea on where we stand right now. So first of all, let me just here point out the non-farm payrolls, which were just released. And I have here my tweet. We can also check it out via admiralmarkets.com. And there you have the Forex calendar where you can check all important news releases, respective. Yeah, news releases, I think it's a good way to put it. And in this regard here, wait, let me just check. Okay, that's interesting. Cool. You see 570, 517 again. Against 189 expected. Previously, R here is revised. So this is probably also revised lower next month. Let's see. So I'm not really sure. Again, that's like, this is again an 8 sigma event. So just to have an idea, let me just see if I have a chart here showing that. One sec. Let me just copy it from here. So that was a tweet from Zero Hedge. You probably know him, and 8 sigma. So I'm not sure if you're familiar with statistics. So probably it's a good way then to say let's just Google that. And wait a second, sigma event. So this is German Google, so that's why I have to. Quora. What do we have here? 6 sigma events. 6 sigma, it's 6 standard deviations away from the mean of a probability distribution. I really have to think about this to not get too pathological here and too complicated. How can I explain this? So did we once talk about this? Probably we did, in terms of a standard deviation. So like standard deviation, let me just see. Yeah, you probably have seen that. You probably know that graphic here. So where you have this, and there you have the sigmas. So that means like a 3 sigma event has a likelihood, or let's say it covers here this it's not the volume. It's like what you can find here in blue below the curve. What's the word for this? Whatever. So it covers 99.7% of all cases. So in 3 out of 1,000 cases, you get a 3 sigma event. And so 4 sigma, 5, 6, 7, and then 8 sigma. So that means if you have an event like this today, you can calculate this. However, this is done. So this is not part of the presentation today, but it's very unlikely that this will happen, which means the reaction in the market is very volatile, especially after the ADP data set. Let's just head over to trading economics and have a look here at what the market expected, or no, what it got to see on labor ADP here on Wednesday. So usually ADP data and NFP data is usually very positively correlated to each other. So this is the private sector here, and there were only 106,000 jobs being added to the economy in the month. 178 was expected, so very close to the expectation here around the non-farm payrolls, and then we get this crushing number. So 570,000, wherever it comes from. Again, revision lower seems very likely, but right now it's creating bearishness. Why? Well, and therefore we head over here to the Fed Watch tool, because let me just update this and then compare this chart here compare this to, so this is the Fed Watch tool I was just referring to. Have a look here, what happened. So you can see, coming back here to the presentation. Oh, I'm sorry, we have it here. So you see 425, 450, and then you add up everything on the left, and you have 18, and you have 50, 56, 57%. So that means that market participants, given what they currently see in the overall economy and the economic projections, respectively, the economic indications, they expect here in the morning, or that was in fact was half an hour before the NFPs were released, they're expecting by nearly 60% that the Fed has to cut 2 times 25 basis points till the end of the year, till December. And then these numbers were released, and you can see now that this likelihood here dropped to below 40%. Because now, if you create that many jobs, as this number indicates, well, if you create that many jobs, the economy is doing quite well. So it's not necessary to loosen your monetary policy path you're following right now. So, and this is something, and there now the idea comes behind this. How does it affect the market? Well, the market is right now dependent on cheap liquidity. So to run higher, let's head over here to the NASDAQ in this case. So you can see 2015, in fact, we can also start here at the COVID pandemic and the liquidity, which was pumped into liquidity. You saw this run higher here, positively correlated to the expansion of the balance sheet of the Fed. So we could show this now, but we won't get too complicated here. So which means if you take away liquidity, if you hike rates, and if you withdraw liquidity from the market, you get to see what we got to see over the course of last year with this sharp drop, in this case in tech sector. So now you can see, or let's probably go to a 50-minute chart here, get a better picture. That was the fat candle. So this is now the NASDAQ on a 50-minute chart. And so as you can see, zoom out a little, you can see that there's a clear sequence of higher highs and higher lows going back here to January. So you can see here, this is the 13th of January. That was the last time inflation data was released, and the inflation came in lower. So if inflation comes in lower, going here to the inflation rate and then going to the United States, where do you have it? There. Well, that means if inflation is already coming down, and remembering what I just said here during the presentation a little earlier, if you have rising inflation, then the central bank is motivated to raise interest rates. Well, that means on the other hand, if it comes down already, well, then the Fed in this case doesn't need to hike rates as aggressive as the market is expecting her to hike rates. So this is the idea behind this. So, and then as you can see, the market is forming kind of a bottom, whatever here. I think that was a PPI or something like that. I'm not really sure. I think so. And then we took off from there and built a very strong case here on the upside. And in fact, given what we've seen here on Wednesday with Jay Powell, who didn't say anything dovish or anything like we cut rates or something like that. In fact, the complete opposite. He said, well, we continue to hike rates. We didn't plan to. There's now certainly a case we have to sit back and discuss here how to continue in the future with further rate hikes. But it hasn't yet started. These discussions are not taking place. We continue to hike rates because we have to counter, we have to fight inflation. That's what he said. So this is nothing kind of dovish or something like that. And the market just listens to one sentence, in my opinion, when he said that this inflationary process has started. So that's what he said. What does it mean? Well, okay, we are about to peak rather sooner or later in terms of hiking rates, and that's why market is taking off. Yeah, it's very interesting, in fact, from a psychological perspective, what we got to see here, but it's a fact that we got to see it. And we got a very strong start into the year here. So that was the January lows. That was the last time when non-farm payrolls were released. You probably recall that. And we also had a live event here. We nearly went parabolic. And from here, that was the lows around 10,600 points, something like that. We pushed higher over 2,000 points on the upside. This is nearly 20% the overall market. And by the way, this is not driven by only one sector, or this is not only driven by, like say, an Apple or Amazon in this case. In fact, when looking at the Apple chart after yesterday's earnings, you will find out that the Apple stock is still trading below its November, December highs here, which is a sign of relative weakness. So this is one of the reasons why you probably should reduce your overall exposure, because it's not a very good earnings release we got to see yesterday. And the growth outlook is also kind of not so positive, which means you have to be kind of careful, but this is not necessary. We don't need Apple. It's the broad market which is pushing higher here in this context. And now we really got steep on the upside. And by the way, let me just, I just have to write something down for my trading a little later on, because certainly given what we currently witness here in the market, there will also be place I have to make in certain stocks. And by the way, I'm not focused on Apple, but in fact, I'm focused on Amazon. We won't dig too deep into now why I'm focused on Amazon instead of Apple. But I think the release, the data, the quarterly report, the earnings release was even weaker than. So given the overall outlook, it looks even weaker. So if I had to build a rank given the big tech names, which just reached earnings yesterday, I would say Amazon is my first play, then Apple, and then probably Google, if at all. So I want to go with the relative weakest stock in this environment, and the relative weakest stock I think is Amazon in this case. But coming back to the Nasdaq then, so you got really steep. Given what we heard from the Fed, you would now say, well, they're speculating that the Fed can ease their tightening cycle here, and the Fed does not need to hike rates as aggressive as the market probably expected it to be, and thus we got this acceleration on the upside. Now the thing is, we got very steep, and we got very good numbers from the employment sector. 570,000. This is way better than expected, and the Fed is unlikelier to cut rates sooner rather than later, but in fact the opposite. Probably keep rates as high as right now and wait until the inflation has come below 5% in this case, which is, by the way, something which is bearish for equities. So if you anticipated that and now get this data release, well, you're selling stocks, or respectively you're selling especially yield sensitive stocks like tech stocks, which is then directly affecting the Nasdaq. And so this makes clear why this very bearish reaction. And now what will be of interest is, in my personal opinion, we have to wait if we get to see, let me just check here. I think that was, yeah, around this here. So this is the low from yesterday when numbers were released from Amazon, Google, but also here a flush lower than that was also on Apple. But I also think what's of importance now and worth looking at is the opening print from yesterday. So that's around here. So yeah, probably a little lower than that even. So probably here. So this is the opening print from yesterday. So we saw a steep rally in the first half of the day, then we sold off sharply, pushed a little higher into the close, came in lower, or numbers disappointed, and we pushed lower. This is the closing price from yesterday. So we are completely reversing the bullishness from yesterday with the price action now around the employment situation. And so what we need to see is now, from an intraday trading perspective, in my personal opinion, if we hold below this blue line, so the closing price from yesterday, if we're currently seeing, so it's now 3:30, so that means we're coming into Wall Street right now, and so initially we see a pop higher. Now, let's see what this means. If this is a sustainable move, if we can make it back above this blue line, if we can hold there. So right now it's 2 minutes. I think the first 15 to 30 minutes will give us an idea. If we can make it above that level, and after an initial pop higher right now, but we are rolling over again, I think this is a clear sign of weakness, and we should expect the NASDAQ pulling in sharper, which means if we now use this line here, we have a serious chance of a retest of this trend line, which, given the fact that it comes in very steep, means that we are potentially pulling in as low as 12,200 to probably even 12,000 points on the downside. So let's see how things play out. If we make it back above yesterday's closing price, I'm not really sure whether the overall environment right now, especially after the run higher, is very inviting, let's say, for the bulls. Probably there will be some kind of profit taking now, while others want to buy at a lower than the highest prices here from yesterday. And there's kind of a, let's say, how can we say that? Exchange, let's say, an exchange of market participants. And then some say, okay, we're buying, some say, well, we are selling here. And then you get kind of a consolidation now. And then we will see where the next impulse will lead us. And this could also be on the upside, given the fact that this extended mode it cools down. That's probably a good way to put it. It cools down, and we're not as extended anymore, and it cools down over time. It doesn't cool down with a sharp pull-in, which will occur then. Let's just see what we get to see. So first of all, again, what is of interest for us now from an intraday trading perspective, whether, so this is a 50-minute chart, whether we can make it above yesterday's opening print, which was around 12,570, 580. So rounding it up, 12.6. If we can make it above 12.6, hold 12.6, I think this is a good sign. And it's making it likely that we'll probably see another push higher and back into the range around 12,700 points. If not, if we, after this initial pop higher now, roll over, hold below, and break below 12,500, I think then we are about to see a quite red weekly close, and lots of profit potentially taking place on the downside, which is also then potentially affecting or driven by, most likely, driven by the stocks which delivered earnings yesterday, which, by the way, I prepared it. So we can just click through this. So Apple here delivered earnings. Revenue came in at 117.2 against 121.2. EPS 188 against 193. That was that's in German, but this was the biggest miss percentage-wise compared to what analysts expect since 7 years, according to CNBC. Apple is a clear market stock. So Apple potentially, I'm not sure, but to be honest, I'm getting more and more skeptical, especially given what was delivered as a reason for that, because most of that was already expected, could be expected. And given the fact that when we head over here to the chart, and let me just see. So this is Microsoft. Microsoft saw a very strong bounce after the earnings, by the way. Let's have a look here. Where's Apple? So as you can see here, we're trading around. So right now there's no trading taking place because this is a demo account. So the reason here I'm getting no quotes is because the live account is not allowed from a compliance perspective, if I'm not mistaken. But we're about to open. Let me just check here. We have it. 49, well, 150. Well, that's interesting. Nearly unchanged to yesterday's close. This is very, very strong, in fact, given what we've seen in the pre-market. Let's see if this continues. But given, I just promised you to show you what I mean by extended on the upside. Let me probably show you here one chart from my end. So this is the Qs. This is the ETF on the NASDAQ 100, and you can already see that here. So it's positively correlated, certainly, because it's the ETF on the NASDAQ 100, but it's also very steep here, given what we've seen since the beginning of the year. And now, still, the question remains, what is steep? And why do I think that risk-reward-wise, we're probably done on the upside. The way I calculate this, what I do is I'm working with the Klatt channel. This is a very simple way, in fact, to calculate volatility, respectively, how much extended we are based on the ATR. So what I use here, so the input parameters for the Klatt channel, it's 50. So this is the exponential moving average I'm using. So the average paid price from the market, let's say over the last 50 days. And then I say, okay, I want to now look at the ATR 22. So 22 is the 22 trading days of a month. So the average trading range, true trading range of one candle here over the course of the last 22 days. 22, and then I say a multiplier of 5 means I want to see, given a 5 ATR move on the upside, respectively on the downside, and if that point is reached, given the EMA 50. So, and as you can see here, we are hitting the upper trend channel, let's say, or channel here, which means that we are now moved from this EMA 50 5 ATR on the upside within a quite short period of time. So this is nearly 1 week, and this is the broad market. So we are talking about the Qs in this case. So it's not just one stock here, which means, given this idea behind the Klatt channel, the market is very extended on the upside, making it unlikely that we'll continue to rise. I mean, certainly we could, and if the market really goes parabolic, we have a potential catalyst for that. It's not necessarily the NASDAQ, but instead, I'd like to have a look here at the commitment of traders report, and here the S&P 500 and how it's positioned right now. As you can see here, so the commitment of traders report shows you how are the big SPACs, the non-commercials, are positioned. And as you can see here, they're still heavily short the market. And that's very surprising, because this data is collected on a weekly basis. And as you can see here, we are now about to break above the November, December highs. We haven't yet broken here these highs from last August. That's probably even more significant. But I think these people who are betting here on a weaker S&P 500, they are in fact getting nervous right now. And if they start to cover their positions, that could result in a massive squeeze on the upside, and something to really keep an eye on here. And this is, in fact, this is the S&P. Let me just go back here. Probably we get the same for the NASDAQ. It's not that significant because the volume is not as high in the NASDAQ future. Yeah, well, this is not really so I prefer to have a look here at the S&P 500. But given what we have here, so the market looks extended and is prone potentially for a bounce, but still we are very extended already, meaning potentially now margin calls are setting in and we are even accelerating on the upside, and this goes really parabolic. So definitely something to keep an eye on here. If we get to see a clear sign that the market is topping out now, again, could be a case of coming back here to the NASDAQ and holding below the close from yesterday. So very strong start into the day. First 10 trading minutes here, we're pushing significantly higher. So this is 100 points or so. Yeah, something like that, 100 points higher. But it's not sad that this is sustainable. If we roll over again and drop here below the price from yesterday, and again drop 12,500, and volatility is given, chances are there that this could turn really ugly and would be a clear sign of a deeper corrective move down to 12,200 to 12,000 points, in fact. So yeah, that's it around the NASDAQ. Let's probably also have a look here at gold. Well, there we go. Didn't expect that to happen that quickly, but I was kind of skeptical here too, and in terms of a potential pull-in, which we could get to see after we accelerate massively, after reclaiming the 200 SMA here. So this is the blue line, the SMA 200. and 1,800. And we entered a very bullish seasonal window between mid-December till mid-January, end of January, which is usually considered to be very bullish for gold, and accelerated massively on the upside and hit 1,900, 1,950. You probably recall around 1 month ago, 2 months ago, I'm not really sure, but Paul mentioned this already, that we could be about to see a test of 2,000, probably push even higher than that. I'm not sure whether you used the word quickly, but at least he was very bullish, and I shared his view here. And as you can see, played out as of now, at least, quite nicely. Still got a little extended on the upside, and now we're pulling in. Why? Well, because rate hikes from the Fed, if they get likelier, or if we don't see a more dovish stance in the near term, this is something which is negative for gold while it's bullish for the US dollar. So usually as a yield less investment, gold is hit hard if yields start to push higher. And good employment numbers, as you now learned, will naturally result, at least in a short-term spike in yields here, thus driving gold in this case lower, even though we're now entering here an area against which longs start to get interesting again. That's probably a good way to put it when looking at this a trend line here, which formed respectively these highs around this area. Let's see whether we can hold that. If not, if we are not bouncing, but now rolling over and dropping these, let's call them extreme lows, that could also mean that we are breaking this trend line then and see a deeper corrective move, which could also push us as low as 1,800 in the upcoming weeks, especially if there's no signs from the Fed that they will cut rates. Respectively, market participants start to get nervous given what we heard from the Fed, in addition to what we now get to see from the overall economy and around the employment situation. So, in fact, that's it. That's nearly it. Let's just see how things play out here. Again, it's a strong opening drive we get to see, but we start to stall out now. This is, by the way, also in an area against which I shorted yesterday, the Nasdaq. I already told you I'm kind of short, so I'm looking at this right now very carefully because it's also the price against which I shorted already. And there was a region I shorted against, and it was around the region which we nearly found support yesterday before we bounced into the close, and then we hit this level again and dropped it with the earnings from Amazon and Google. So that was an interesting area here to look at, and let's just see whether the market reacts. Obviously, it reacts against this area, so that's something you can clearly see after strong opening drive. But now let's see if we continue to push higher from here, or if we roll over again, and if we drop then below the closing price from yesterday, things could at least result in a test of these lows again. And then let's see how things play out from there. So that's it. From mine. I hope you enjoyed the webinar. I hope you take something out of it. And by the way, let me just go back here to the presentation and here close with the last slide. If you have any questions, please feel free to reach out to Admirals directly. I think there's also a little questionnaire at the end of this webinar. Please take the time to answer the questions, give a feedback, what you would like to present us in the future, and so on and so forth. Much appreciated. And that's it from my end. So have a nice weekend. Enjoy yourself. Talk to you again next week on Friday then, on the 10th of February. I really look forward to it. All the best. See you.